Hey class, this is Roy again, this time with a video for chapter 4. The topic is tax-free or non-taxable income. The word we use here is called exclusions, the different types of income that's not taxable. So some general rules for items that are not taxable. We've talked about in chapter 3 the term realized. For a transaction, for a sale to be taxable, it has to be realized or the sale has to take place. So if you have an asset that is increasing in value but haven't sold it yet, you're economically better off, but that additional benefit is unrealized because you haven't sold it yet and you don't have to recognize or report that income yet on your tax return. Let's say that here in the second item, you have a business. You sell services to other people and make a living. Well, that income would be taxable. But if you use those services for your personal benefit, your personal situation, then that service is a tax-free benefit to yourself. So let's say, for example, as a income tax preparer, I professionally prepare tax returns for other people and they pay me, and that's taxable income. But if I do my own tax return, I'm not going to charge myself and report the income, right? There's no income there. There's no money being transferred. I'm doing it for my personal self, not professionally. So that so-called self-help service is not taxable. Now, what is a little bit more questionable is if, let's say, now you do this service for a friend, for family. So let's say that you're a plumber and you do plumbing work for your parents. You're not going to charge them, right? You're going to do it for free. Is that really income to you? Make believe money that they pay to you and you pay them back? Now, somewhat questionable. Now, if you expect something in return, maybe not cash, we saw the term barter in the last chapter, yeah? Then technically that service you provide would be income, the benefit you get. But definitely for yourself, that shouldn't be reported as income. Likewise, if you own property, here they call it personal property, property that's not real estate, and you use it for yourself, that's a tax-free use. Now, if you let other people use it and don't charge them, like maybe you lend your car to your sister, well, I think that's also a tax-free benefit. But if you expect something in return, like definitely money, then you're should be reporting that as income. Here they talk about the gross price of selling something is not really the income that you report. What you really report is the profit on the sale. So we talked about the sales price minusing out the cost of what's being sold to get the gain. That's the income, yeah? This sales price is not the income. This gain is. Or there could be a loss. The loss could be deductible or not, depending upon the rules we'll see in a future chapter. You can substitute this word cost here in the case of merchandise being sold as the cost of goods available, no, cost of goods sold. Yeah, and we learned that you subtract that out from the sales price to get the company's gross profit. Again, this is the income that is taxable, not necessarily the sales price. Or if you sell equipment, the building, then you would be subtracting out the so-called book value of those assets from the sales price to get the gain or the loss. Again, this gain or loss is the amount of income, and again, not necessarily the gross sales price up here. So here's a list of items this PowerPoint slide says that are tax-free. But again, some of these items we saw as in chapter in chapter 3 as includable or taxable. Includable. Includable. Yeah. Or we learn sometimes it's not too clear. Some items could be both includable and partially excludable. So things we saw back in chapter 3, like tax exempt interest, the municipal bond interest, or savings bonds used for qualified education costs, or a tenant making improvements to a property and leaving it for the landlord, or let's see, property settlements or child support payments, or Social Security benefits being received. This is covered in our previous chapter 3, where we saw it is taxable or non-taxable. Now we're seeing it here again in chapter 4, and we're not going to go over those items again in chapter 4. So go back in chapter 3 if you have questions on these specific items. For home sale, for distributions from a IRA, we'll see this in future chapters. So let's take a look at some of the exclusions, starting off with gifts here in the next slide. Gifts are made during the lifetime of whoever's giving the gift. We call that person a donor. And the person receiving the gift is called the donee. Again, this gift is made while the donor is living. So let's say that you inherit property not during the time the person here is living, but when they die, and we call that an inheritance or a bequest. So the person who died is called a decedent, and the person who's receiving the property, could be cash, is called the beneficiary. So in either case, typically this is given because of love and affection or admiration. And here the general rule is that whoever's receiving it is not income taxable on it. Now there is such a thing called gift tax or estate tax that is going to be taxing not the people that receive the benefit, but the people that gave the benefit. In this case here, the decedent's estate. And typically there is no gift or estate tax if the total giving of that person is less than, I believe, something like 5.5 or 5.45 million, somewhere around there, during their lifetime. So tax returns have to be filed for gifts during a year if the donor gives more than 14,000 to the donee, that one donee during the year. You can give to multiple donees, but once the donor gives more than 14,000 to a single donee during the year, then you have to file a gift tax return. And anything given over 14,000, it accumulates, including the amount paid out by the decedent's estate, to get to this exempt estate tax, not income tax now, estate tax of over around 5.5 million. Okay, what we're focusing on here in our class is income tax. So gifts made by the donor to the donee, inheritances given by the decedent to the beneficiaries are usually income tax free. Here it says prizes and also awards are not the same thing as gifts like we're talking about up here. So usually prizes and awards are taxable. Also, if the employer gives an employee additional money, really that's additional taxable compensation. Not too common in the case of an employer, a company, paying, let's say, the family of an employee on the employee's death a gift. Typically, if you see that situation, it's really the owners of the company giving the family of the deceased employee. Yeah, and again, gifts or inheritances are tax-free. But if it's related to employment, typically that payment is a taxable compensation. Life insurance. Here, the general rule is whoever receives a life insurance benefit is receiving that income tax free. Here it talks about an exception that I've never seen before. So typically, if someone purchases a life insurance policy and then someone else buys it that has no um, insurable interest, insurable risks. Take an insurance class at UH Westwall and you'll find about all these terms, yeah? But they don't have an insurable interest. That means they're in it for the profit, in it for making money, a business. In that case, possibly it is taxable whoever purchased that insurance policy that has no insurable interest, probably a non-related person. Here it says that if the amount received on insurance policy is bigger than the policy amount, then anything extra you receive over that is probably interest income or annuity income that is taxable. So typically, if someone dies, if you collect the whole thing right away, the proceeds of the insurance policy, that's the face value, nothing extra. But if you tell the insurance company to keep it and give me a little bit more over so many years, that extra is probably taxable interest or taxable annuity. Here it says if the person that owns the insurance policy sells it for more than all the premiums that were paid, then the extra you receive is possibly going to be taxable. The exception to that taxability is if the owner, the insured person, is terminally ill, probably going to be dying within 24 months. Then instead of waiting for the person to die and then the beneficiary is collecting the money, the insured person needs the money right now to have a comfortable rest of his or her life, yeah? So here it says up to $360 can be received on that insurance policy, life insurance policy, tax-free. $360 per day. If you cash in your insurance policy and collect less than the total amount of what they call the cash surrender value, you cannot claim a loss. Typically, you would be claiming a gain if you receive more than the premiums, yeah, if you cash in your policy. But cash surrender value definitely going to be less than the total premiums you had paid. There's something called dividends on life insurance policy, and technically that's tax-free. I believe for a life insurance company that's a mutual life insurance. In other words, the policy owners are the insurance company owners. The dividends are really just savings on sharing the profits of the company, either going into the cash surrender value or reducing the premium costs. Now, it's possible that these dividends earn profits on themselves. So what you're going to get is interest income, which is taxable. Dividend income on a life insurance policy, non-taxable. Interest income on a life insurance policy is taxable, and the insurance company will issue out a 1099 INT form for that taxable interest. Not so for the non-taxable dividends. The general rule for prizes and awards is that it's taxable. Here they go through an exception, but the catch is way down here saying that if you have to give that award to a charity or to the government. Who wants to give their award to the government? That's like paying a tax, yeah? So the general rule is that prizes and awards are taxable income. Let me expand on this also. Even if you do something really good, like win the Nobel Prize or win an Olympic medal, especially a gold medal, the cash you receive, the value of the medal is taxable income. Let's say that a lot of you have financial aid going to college and you're either receiving a scholarship or the word is grant, especially Pell grants. the general rule is that that type of income is non-taxable if you use that money to pay for qualifying education costs. The scholarship has to be paid because you're attending a qualified higher education institution and trying to earn a degree. Qualifying education costs includes, of course, the tuition, any related fees, required books, supplies to help you study, including your computer. I know you're using a computer right now to watch this video, and you have to have a computer to do your homework and submit or upload your homework files, especially your coming project. Now, if you receive scholarship or grant to pay for cost that's not qualified, then that spending of or receiving of the scholarship is taxable. So if you use your money for room and board, for laundry, for travel, even if it's school related, that money is taxable. So you gotta make sure if you want to not pay any taxes on your scholarship and grant that these costs are greater than or equal to than your scholarship or grant. Here's the form that you'll get that you can probably download from your MyUH account after, let's say, January next year for the year 2017 to get the amount of tuition that you paid or were billed. This is Form 1098T. 1099 typically means income, yeah? 98 typically means some type of payment or deduction. In this case, the payment of your tuition. It may not include any fees, may not include any textbook costs here in these numbers. Also on this form is the amount of scholarship that was received by this college here, for this student here, for this calendar year, not academic year. So if you receive a scholarship that wasn't paid to the school, then it won't show up here. If the money, that scholarship went straight to the student from the awarding organization, it may not show up over here. It's only scholarships received by the school for the student that ends up here. Keeping in mind that the scholarship may not necessarily apply for only costs in calendar year 2017. Maybe this was for a previous semester or for the next semester to 20 compared to 2017. So there's always a timing issue that you have to kind of calculate to determine whether you do have a excess taxable scholarship. So let's say that you want to save for someone's higher education costs. You can't maybe depend upon your student being a gifted scholar or athlete, not going to get a scholarship or grant, or maybe not poor enough to qualify for a grant. Well, a lot of middle class or even especially higher income taxpayers want to save in a tax efficient method for their children. So what they will set up is a Section 529 educational savings plan, educational savings account. So typically, let's say this is the Section 529 account. And typically it's the parents, some relative, contributing money into this account when the child is still young. And investing in hopefully profitable investments so the value here is increasing. So that contribution is not going to be deductible. That's not the tax benefit. The benefit is the increasing in value. You don't have to report that as income. It's a unrealized gain or loss here. The true benefit is when you take out the money and you have to pay using this money for qualified education costs again. Now this distribution out of the plan is going to be tax-free. Again, the benefit is the increasing in value is not going to be taxable if the distribution is made to a qualifying institution. Again, typically a college or university, and has to be for, again, qualifying costs, which does include room and board this time, unlike the scholarship and grant situation. Here it says it's kind of popular among wealthy taxpayers because the contribution, again, that's the money going into the plan, is not limited to the contributor's income like some other situations. We'll learn about another type of educational savings device called a Coverdell Education Savings Account, where you're limited in contributing based upon a dollar amount of contribution per year, but the main one is the income that the donor is putting in cannot exceed a certain amount. And likewise, when you take out the money, if you pay for qualifying education costs, the increasing in value here, there's no deduction when you put the money in, but the increase in value is tax-free, excludable. Um, that 529 account is nice because it's easier to change the beneficiaries. This is the student here. You have to designate who is going to be the student. Typically, it's a son or daughter. And if that son or daughter doesn't need the money for higher education, you can switch it to another person in your family, possibly even your spouse. If you use the money in this educational account and don't report any income, you cannot use the costs to claim what they call education credits. And we'll talk about the education credits. There's two types in a future chapter. So here's the form that you would get, be it the owner of the 529 account or the student, showing how much was taken out for their benefit. And as long as, again, this amount is used for qualifying education costs, you don't have to report any income. Now, if not all of this was used for the education costs, you're not going to report that amount as income. You're only going to report the earnings part of the distribution as taxable if there is no excess costs. Yeah, you have to use it all for costs, and then it's going to be all tax-free. So let's change the type of income here. This time, you're receiving money for being injured or for being sick. Now, we know that costs for reimbursement of medical expenses should be tax-free. I think that was mentioned back in Chapter 3. What we're talking about here is additional payments. So let's say that you have something called disability insurance. Here in Hawaii, we call it temporary disability insurance. If you get money from this insurance policy because you're hurt or you're sick, it may or may not be taxable. If it's treated like sick pay, then it is taxable. There is also something called workers' compensation insurance. If you get hurt on the job and they pay you this is tax-free. This is a premium payment made by the employer. Yeah, and if you collect on it, it should be tax-free. This is probably a payment made by your employer, at least here in Hawaii. The employee could pay a little bit, I believe, of this, but most times the employer pays the whole thing. If you collect on this, it's like sick pay. That's taxable. So if the payment for the physical injury or the sickness is excludable, any payment for emotional distress related to that physical injury or sickness is also tax-free. If it's taxable here, then the related item here is taxable. Now, if you're only getting money for personal pain and suffering for mental or emotional distress, generally that's taxable. But again, if it's related to a physical injury or physical sickness, then it's tax-free. maybe you get to sue someone because of not because of that type of damages we saw in the previous slide. But now to punish the wrongdoer, the court charges a punitive damages to be awarded to the injured party. Punitive damages are always taxable to whoever receives it. Yeah, this is in addition to those other compensation we saw in the previous slide. Amounts received under an accident and health insurance policy are excludable. Um, this is again talking about that disability insurance I mentioned in the previous slides. If the employer pays for the disability insurance, when you collect on it, it's going to be taxable to our employee. If the disability insurance was paid by the employee, the premium, and when the employee collects it, that collection is tax-free. Yeah, it depends upon who paid for this. Also, the premium paid for this disability insurance, if the employer paid it, it's a tax-free benefit. Again, that's the payment of the premium, not the collection of the insurance. Yeah. Now, if the employee pays the premium for this disability insurance policy, it's not deductible. But again, when they do claim the proceeds on the insurance, it's going to be tax-free to the employee if the premium was paid by the employee. Long-term care insurance. This is quite expensive, so not too many people have this type of policy. But if you can almost treat it like, at least for tax purposes, the premium payment of this is almost like medical insurance. And it can be tax-free when you do collect on it, up to $360 per day coverage. I think we saw that same amount if you were cashing in your life insurance early. So here we're having employer pay wage, salary, compensation to the employee. That extra we get now is called a fringe benefit. And fringe benefits could be taxable or could be tax-free, includable or excludable. The general rule, of course, it's includable, taxable, unless specifically excluded by law or as we're going to see maybe some practice. So here's some example of dimension excludable fringe benefits. I kind of disagree with this gym membership here. Yeah, we'll maybe see an example of that in this slideshow. So the payment of insurance by the employer for the employee, the payment of that premium now, not the claiming of the insurance, the payment of the premium is a tax-free benefit to the employee. Here they specifically talk about life insurance called group term life insurance. Generally that's tax-free, but here's an exception where it can be taxable. It is tax-free if the coverage is $50,000 or less. If it's more than that, the extra premium paid for that extra coverage is a taxable fringe benefit. And there's a calculation, a table in our textbook to figure out how much is taxable of that additional premium payment if it goes over $5,000. Any benefit paid for disability insurance are included in the income if the premiums were not included. In other words, this is again disability insurance. The payment of the premium is a tax-free benefit to the employee. But when you claim the benefit by the employee, that insurance received is taxable. Here it says that if the premiums were not a tax-free benefit to the employee, in other words, the employee paid the premium. Now, when you claim that disability insurance benefit, it is going to be tax-free to the employee. You see how it kind of balances out? Either you get a benefit up front, now it's going to be taxable later on, or you get no benefit up front, and then it is tax-free later on. Employers may deduct expenses. Employees generally don't have to include it in income. Hopefully that's the general rule, right? Employee gets a benefit, reducing their taxes because they get to deduct that cost of the benefit. And the employee gets the benefit but doesn't have to report it as income. So here it says that you cannot discriminate among your employees. So discrimination here is not defined as racial or sex or religious discrimination. It's based upon high and low paid employees. You cannot just favor your officers that are paid high or the owners of the company who are employees, right? You have to treat everyone alike in this fringe benefit program. Now, there's some exceptions where you can discriminate, as mentioned over here. So one type of fringe benefit specifically that is excluded on this Internal Revenue Code section is if it doesn't cost the employer any additional costs to give this benefit to the employee. So the common example is airline employees can travel standby income tax free, that benefit. And the reason why, it really doesn't cost the employer that much to fill up an empty seat. Yeah, that would have gone empty anyway if you don't put your employee in there. Same thing with hotel rooms. The vacant room would just sit there. Why not just let an employee stay there free, and that benefit will be tax-free. Keeping in mind that the employee has to work in that type of business. In other words, if you have a company that owns both of these types of businesses, you cannot give your hotel employees tax-free air travel, even though the company owns that air travel or the airlines. If the employee is given a discount for services, as long as the discount is 20% or less, that's a tax-free discount. Now, maybe you want to kind of work this service into the no additional cost. Yes, the whole thing would be tax-free. If you sell merchandise to employees at a discount, as long as the employer is not losing any money, not selling the merchandise then less than its cost, that can be a tax-free benefit to the employee. Working condition fringe benefit typically means that we're going to give you this benefit to make you a better employee. So typically paying your conference fees, paying for business subscriptions, paying for professional memberships, okay, related to your work. Here's a Latin term, de minimis, or here in Hawaii, tu manini, to worry about. Small stuff, like the proverbial turkey you give at Thanksgiving or Christmas here, yeah, to your employees. Non-taxable to your employees. Too small to worry about. So let's say that you have employees eat business meals or they entertain clients, and they of course gonna have to eat and attend these entertainment events with their clients or customers, and it's going to be a tax-free benefit to your employee. We'll see that maybe the deduction will be limited to the employer, but as long as it's business related, including business travel, it should be tax-free to our employees. I've never seen this, but if you give your employees an adoption reimbursement costs up to this amount per year, maybe even per child, is tax-free. There's a rule here about income limitation. So if you earn more than this, possibly all of this is not tax-free. So you can see it's probably geared to the higher income employees. Typically, again, when an employee's family estate receives money after the employee dies, that's just pay that was accrued and hasn't been paid prior to the employee's death. So it's going to be taxable to whoever receives it. Dependent care, up to $5,000 worth of dependent care, be it child or elder parent, could be tax-free. Typically, what people do instead is have this money taken out of their pay to reduce their take-home pay, to reduce their taxable salary or wage, and then ask for the money back as a reimbursement. So the way this is set up is through something called, here on the next slide, a cafeteria or flex spending account. So let me illustrate this here. How about we use a black screen here? So here we have an employer and our employee. Most of us can appreciate the viewpoint of an employee, and we get our salary or wage. And of course, this is going to be taxable to us down here. And let's talk about some of the so-called fringe benefits besides your regular salary or wage. So hopefully one of them is health insurance. So we'll call this health insurance company. So the big one here in Hawaii is HMSA or Kaiser or HMAA. So when you, as the employee, have to go see a doctor or healthcare provider, and they're going to charge you, hopefully most of that is being paid by the health insurance company. And you got to pay something called a deductible copayment. Well, this insurance is not free. Hopefully your employer is paying this premium for this benefit here. Tax-free benefit here. This is a tax-free benefit here to our employee. Now, if you're like me, my employer says they're not going to pay the whole thing. I got to contribute into that premium payment. But the nice thing for tax purposes, when they take out my share of the premium, which is little less than half of the total premium, is that it reduces my taxable salary. Okay, so this is a before tax payment. Now you see this payment over here? I can use this as a deduction, but possibly something better is to use my flex spending account. So if the employer can set this up, you can divert some of your take-home pay, or an employer can even fund it themselves. My employer just let me contribute to it. They don't fund it. I work for the state of Hawaii here as a teacher. And when I do make this payment, I can request a reimbursement here. Now I cannot deduct this cost on my return, but here is tax-free money, pre-tax money here for this cost. Yeah. There's a dollar limit you can put in here for medical costs. I think it was $2,600 on the Affordable Care Act. Another thing you can fund with this flex spending account is, let's say I have a child under a certain age, or an elder parent I need to take care of while I go to work. So I have a care provider here that I gotta pay. And to help me fund this, I can take out money again from my paycheck pre-tax and pay this and ask for a reimbursement here, yeah, to cover this cost here. Again, tax-free. There are benefits of trying to deduct or take a credit for this and this, but if you're using the costs to get tax-free benefits, you cannot use the costs again. That's what they call a double benefit, tax benefit, and that's usually not allowed for tax purposes. We'll talk about other benefits, like let's say a retirement plan, typically a pension, profit sharing. Hopefully the employer contributes a lot for you, but again, they want you to contribute too, like a 401k contribution. So when you do retire down here, then you start to draw out as taxable income, but in the meantime, the income up here will increase tax deferred, postponed, until you take the money out, a distribution. Hopefully at that time, you're not collecting your salary anymore, and this retirement income won't be pushed up into a higher tax bracket. Let's continue in our slideshow. We just talked about this flex spending account. Transportation costs could be tax-free. This is the one you can discriminate. Um, Bus passes are also common here, free parking. Look at the costs here. This is may not necessarily be tax-free if they reimburse you for, let's say, gym membership. Now, if the facility is employer-owned on the employer premises, then possibly the use of that facility is a tax-free benefit to the employee. But if they're just reimbursing you to go to a private gym, private uh, facility for exercise and health and wellness, yeah, that probably is a taxable benefit. Educational assistance, your employer can give you this amount to pay for your um, undergraduate, grad, or even workshops for job-related costs. I'm not sure if it's limited to job, but if it's, let's say, a degree and you're taking courses that are unrelated, but it helps you get that degree, that this amount should be covered as tax-free. Meals and lodgings, here's the rule. It's for the benefit of the employer, not just additional compensation for the employee. And it has to be on the employer's work site, employer's premises. So if you're just giving extra food to the employees for their enjoyment and not for the employer's benefit, it's a taxable benefit. If you're giving food or money to the employees and not having them eat or live on the employer's premises, that's a taxable benefit. So the typical situation where it's tax-free, at least for the lodging, is for a fireman to live at the fire station, the firefighter, right? The lodgings, the food, because they gotta be there in case there's an emergency, so they can hop on that fire truck to get to the fire faster. Or here they say a hospital has a cafeteria and it has discounted meals to promote their employees to stay on site in case there's a need for their services, and they'll be faster, ready at a faster pace. You may not require them to eat it there, but it promotes, again, for the convenience of the employer. Foreign earned income. This word here, interpret this as work income, like a wage or salary, or even business income, and not investment income. Okay, you gotta sweat here to make this money. And it's for US citizens or US residents. They gotta report all of their income worldwide on their annual 1040 form. But maybe you can exclude, take out tax-free up to $102,000 of this work income if they're working for a private company, be it a US company or a foreign company. Now, if you work for the US government, be it in the armed forces or as a government civil service worker, then technically this exemption exclusion don't apply to you. So the amount again is this. There's also a housing allowance that could be tax-free. To qualify for this exclusion, you have to meet a time test. Or here they say you have to be a resident of that foreign country, or you have to be there so many days out of 12 months, consecutive months. Um, if part of these days are only for the current year and the rest are for the next year, then that exclusion is kind of allocated. Again, you cannot get a double benefit. Here it mentions in the previous slide, you cannot claim the foreign tax credit. And we'll learn about credits in our last chapter of the semester if you are claiming this exclusion. Here's the form, 2555. Really, it's 3 pages long that you have to fill out if you're claiming this exclusion. So let's say that you owe money to someone, your parent, and then your parent says later on, oh, you don't have to pay that back anymore. Well, that is really a gift, yeah, love and affection, that you don't have to pay the money. But if it's in a business situation, if you owe a business money and they say you don't have to pay back, well, typically that means you have to report cancellation of debt income. You're better off because you're not paying that money back. Sounds kind of illogical because you're so poor you cannot pay off the loan, and now you have to report that unpaid loan as income. There's two exceptions to not taxing cancellation of debt income. One is if the taxpayer is in bankruptcy, and the other is somewhat similar. The taxpayer is insolvent, but not in bankruptcy. So I know you guys remember in your previous life as an accounting student, yeah? This so-called accounting equation. So we know this has to balance, and when you're insolvent, these liabilities are so big compared to your assets. Remember, you got a balance here, right? If these liabilities are bigger than your assets, that means this equity goes negative, or you're so-called insolvent. So let's have a situation here with numbers. I have $5, could be $5 billion of assets. Here's $7 of liabilities. So what's my equity here? Got a balance, so it's insolvent by $2 billion. So let's say that the lenders you owe money here to trying to make an agreement so you do eventually pay something. So they're going to reduce your liabilities by, let's say, by 3. So you end up owing still $4. Your assets didn't change. It's the same assets you own before and after the cancellation of this $3 of debt. So how much equity do I have here now? Again, you got to balance, right? So now you are solvent. You're canceled $3 of debt, and it made you solvent by $1. This $1 is taxable to the extent you go over 0, yeah, that you are solvent on the cancellation of this debt. That excess is going to be taxable income of the amount that was canceled. So let's say that the loan you owe is a student loan, and typically student loans are never forgiven. I've seen it forgiven. I've seen actually cancellation of debt income here. I thought it was usually stated it was never forgiven. Certain situations it is forgiven if the student graduates and goes into a certain profession, probably in a location that is in need of that. Most times it's healthcare workers or possibly teachers, and if they work there for so many years, their student loan is forgiven. In that case, that forgiven loan is non-taxable. Here's the form that you get if there is cancellation of debt. Again, income, 99, not 98. And again, cancellation of debt. This shows you the gross amount of the debt. Now, there may be other situations, especially in the case of repossession or foreclosure, where you give up the property, that can actually be treated as a sale, yeah, for this amount here, compared to the cost basis. So we'll talk about that possibly in a future chapter, but the debt itself that's forgiven is possibly income unless you meet some other exception. And in 2016, at least in the case of qualified residential mortgages, it could be, I believe, excludable up to, I think it was $500,000, $500,000. I'm not sure if the rule carries over now to our current year, 2016. Maybe the Congress will pass some rule before the end of the year to have it still excludable. Okay, that's it for chapter 4. I'll try to work on another video going through one of the problems at the end of the chapter, preparing a tax return.